Hey guys, I wanted to do a quick video on how I choose the expiration date and the strike price for my options trades. And this is mostly just regarding the straight option trades, either long calls or long puts. Okay, so let's dive right into it. So this is how I choose the expiration date. So if I'm just buying calls or puts, I like to buy at least 5 to 7 months out, and that's because they have a low theta or a low time decay. Okay, so the reason that I like to buy this much time, and I will discuss it in great length further along in the video, but basically this is how it works with options. The closer you buy, so if you buy just 1 month out, if your option expires 1 month out, that option is going to be losing a lot of value every single day. And that's why most people fail at options, is because they have the options working against them and not for them. Okay, the biggest factor of failure for people in options is that they don't understand theta and how it works. Okay, so essentially your option is decaying every single day and based off of theta, and when you buy an option that's expiring 5 to 7 months out, it has a very low theta. It still has a theta, so you still have to deal with it, but it has a very low theta. Okay, and the reason I'm mentioning here, between 5 to 7 months out, is because sometimes an option won't have an expiration for every single month, like May, June, July, August, October, or September, October. Sometimes they'll skip a month, so sometimes it'll be May, June, and they'll skip July and then go to August, something like that. So that's kind of how that varies. Okay, so there's a common misconception with options. I get this question all of the time. And they say, when I'm buying these options that are 5 to 7 months out, they say, why are we holding this option for such a long period of time, 5 to 7 months? And here's the misconception. You don't have to hold that option for those 5 to 7 months. You can day trade an option that expires 5 to 7 months from now. You can buy and sell an option anytime before the expiration date. Okay, so right now it's March. As of this video, it's March. And if I were to buy an option that expires, let's say in December, I can sell that. I can buy that option today, and I can literally sell it 5 minutes from now. I could sell it 5 seconds from now, or I could sell it in December. Okay, it doesn't matter when you buy it. All that matters is the expiration. Okay, so and the reason that I buy the further out expirations is to neutralize theta as much as possible. Okay, notice how I didn't say eliminate theta. I said neutralize theta. There are strategies that you can use that I'll cover in other videos where you can actually eliminate theta as a factor. But for when you're going long calls or puts, just buying calls or puts, buying 5 to 7 months out, even when you're holding trades for about 10 days like we normally do, is a really good idea, because you're having theta work for you rather than against you. Okay, so why we neutralize theta? The number one option, or the number one reason most people fail at options trading is because they don't buy enough time. Options are losing value, like I mentioned earlier. They lose value every single day. Okay, and the further out the expiration, the less theta you are dealing with, and the less your option expires every single day. So to explain it a little bit further, and if you already know about theta and delta and all that, then this will just be a nice little refresher for you. So theta explained. So each option contract has theta, or time decay. Okay? So let's say an option contract is worth $1 and has a theta of 15 cents. This means that every single day that option will lose 15 cents of its value. Okay, so if you're holding an option for 7 days, 7 times 15 is 105, which means that that option contract that started at $1 would be worthless, okay, after 7 days, because that option has that theta ticking away at it, chipping away at it every single day. So even if the stock traded sideways, that option is losing value. Okay, so even when you're, when you hold a stock, if it trades sideways, you do not lose money. Okay, but if you hold an option and it's trading sideways, you are going to lose money. Okay, so that's why you have to give yourself plenty of time, and that's why we trade options that are 5 to 7 months out in expiration, because then if our stock trades sideways for 10 days, then you're going to be able to profit. So I'm just going to show you a real life example. This is just a trade that we took recently, and we entered here on this day, and as you can see, it traded sideways for about 12 days. And if we had bought an option that was expiring in, let's say, a month, that even with this breakout that occurred right here, we still probably would have been either break even or losing money because of how much theta would have decayed the price of that option down here. Even though the stock moved much higher from our entry point, your option can still be losing money. All right. So that's that. The next slide here. So that previous example that I showed you, where the option contract is worth $1 and the theta is 15 cents, is very typical of a closer expiration option. So if you bought an option that was just 1 month out, okay? Now if you buy a 5 to 7 month out expiration, the numbers will look more friendly, okay? They'll look more like this. An option contract worth about $6 and a theta of 4 cents. Okay, so if you're holding that option for 7 days times 4, that's 28 cents that option would be worth. Or I'm sorry, that's 28 cents that the option would lose value over that 7-day period. So your option would now be worth $5.72 after 7 days. So it's still losing value, but nothing crazy. Okay, nothing crazy, especially when you're considering most of our trades are 30% to 50% winners. This small decay is not a huge factor. Okay, so let's take a look at some real life examples. Now, at the time of this video, it's March 8th. So April would be just a month out, and July would be March, April, May, June, July, about 5 months out from where we're at. Okay, so looking at the QCOM April calls here, we're looking at the 52.50 strike. You can see that it's worth about $2.78, something like that. Right here you can see the bid and the ask. Right here you can see the last trade was right here at $2.78, and you can see that it has a delta of 61 cents and a theta of 2.5 cents. Okay, but the main thing you want to focus here is that that theta right here is 2.5 cents. Okay, 2.5 cents versus a 278 price of the option. Now, looking at that same strike, but in July, right here, we've got an option contract that's worth about 430, and you can see, so the option contract is worth more, and the theta is almost half right there. It's almost half. So that's a huge, huge difference. I mean, that's like a 4x multiple. So not only is the option worth more, but the theta is less. So huge, huge swing here. All right. So again, the option contract was half the value, but double the theta in April compared to the July calls. That's a big difference. All right. So that means that the April calls are losing a lot more value of the price of the option, and the price of the option is already lower. Okay, the price of the option is half what it is versus July, and the theta is double to what it is in July. So you've got two things working against you when you're buying that closer expiration. So the next thing that I want to cover here in this video is choosing a strike price, how I choose a strike price. There's many different ways to trade options, but this is kind of my preference and a lot of people's preference who do this successfully. So your choices: you can either buy an out of the money option, or you can buy an in the money option. OTM or ITM is what they're commonly referred to as. Okay, so got to keep it simple. All right, everything you got to keep it simple. So what you want is a high delta and a low theta relative to the price of the option. So a quick lesson on delta. All right, so delta moves the price of an option. Okay, so here's a quick example. So an example is an option contract that's worth $1 and has a delta of 30 cents. So what that means is that for every dollar that the stock moves up or down, the option will move 30 cents. So let's say this is a contract for Apple, and Apple is trading at $100. If Apple, and that's when you buy the option, okay? Let's say Apple moves up $1 and goes to 101. That means that this option contract would now be worth $1.30. All right? So let's say that Apple moves down $1 from $100 to $99. That means the option contract would lose 30 cents of value, and it would go down to 70 cents. Okay? So that is a quick lesson on delta. So let's take a look at some real-life examples for choosing a strike price. All right, so let's go back to the July 5250 strike calls. All right, 5250. The price of the option is about 430. All right, the delta is 59.6 cents. The theta is 0.014. All right. Now, the delta is 13.86% of price. Okay, so that just means that, what is this? 59.6 is 13% of 430. Okay. Theta is 0.32% of price. Okay, so that means 0.014 of 430 is 0.32%. Okay, so what we want is a high delta and a low theta relative to the price of option. Remember, we want the option to move more for us right here with delta, but we don't want it to decay. Okay, so we want less theta. More delta, less theta. Okay? And you got to find a balance between that. All right? So, let's take a look at another example. So we're going to look at the July 60 strike calls. All right, here they are. You can see the bid and the ask here. The last price was $135. Okay, you can see the delta is 0.278. And you can see that the theta right here is 0.011. Right, so this is an out of the money option. Okay, I guess I should have explained that earlier. But this is what, if you don't know, when you have in the money, right now, the current price of Qualcomm is right up here, okay, $53.64. All right, so that means that anything that is below $53.64 is in the money. So that means $52.50, that price has already been passed by Qualcomm. So that means it's in the money. But 55, that is above the price that we're currently at. So it's out of the money. All right? In the money, and everything you see pictured here in blue, out of the money. Same thing over here, just in the opposite direction. These are the puts. All right? So the $60 strike calls are out of the money. All right? So remember the example when I said in the beginning of this section, I said we are choosing between in the money and out of the money options. All right? So here's the example. The price of the calls are $135 and have a delta of 0.78. I'm sorry, 0.278 and a theta of 0.011. The delta is, so 0.278 of 135 is 20.59%. Theta is 0.81% of the price. All right, so that's a much higher theta relative to price than the in the money option was that we previously showed you. Remember the previous example? Right here, theta was 0.32% of the cost of the option. All right, so that was good. Now we have a higher theta relative to the price of the option. Okay, so, excuse me, I like to trade options that are slightly in the money because they have a high delta, but most importantly, you have a low theta. All right, theta is the most important thing, at least in my opinion, for options. Okay, by neutralizing theta and time decay, and again, we're not completely neutralizing theta, we're just neutralizing it as much as we can. You're making options work for you and not against you. Remember, the enemy of an options trader is time decay. Okay, that is the biggest thing that people need to pay attention to when they are trading options. All right, so that's the lesson here. If you have any questions, please let me know. I hope that you enjoyed this video.